welcome everybody to our very first web event of 2021. Brian Dobbis and I were just actually commenting on that. We would prefer to have done this, live and in person. And it's just kind of a point. Brian and Joe were actually our very last live event that we were able to do. It was almost a year to the date. They were with us last February as the Secure Act rolled out, and we were able to talk about it, but then that quickly got swallowed up by the CARES Act and became a lot more important to everyone as the pandemic, kind of took hold. But we're really happy to have Joe and Brian back with us to kind of dust back off the Secure Act. And there's some really important things there that they're going to cover over the next hour or so. But again, just wanted to say thank you very much. Really appreciate everybody spending the time with us. We truly value your friendship, your partnership, and certainly appreciate it. And we think this will, be a good use of your time, hanging out with the Stonebridge family for the next hour or so. For those of you joining us for the very first time, I wanted to give you just a quick introduction to Stonebridge. Eric Boehm and I founded Stonebridge in 2011. We started Stonebridge as a fee-only registered investment advisor, working with individuals and businesses largely in the Southeast, kind of playing on mine and Eric's, now we're going on, I guess, 25, almost 30 years each experience in the investment business, and kind of bringing that to what we love and what we're passionate about, managing money and working with folks. And also from the Stonebridge team, we've got Tom Francescan and Mike Greer. Tom has been with us better part of 6 years, maybe even right around then or so. He's affiliated with Dave Ramsey's SmartVestor Pro program. He's a SmartVestor Pro advisor. Tom works with individuals and families, creating tailored investment portfolios, working with them to kind of create very custom, very specific financial plans. And I'll put Tom on the spot here, but a big congratulations to Tom. He and his wife, Dell, just celebrated what was the anniversary, Tom? You're on mute. You got to tell us. Take it off mute.
46. Thank you.
46 wedding anniversary.
Got married when I was 15.
That's awesome. Well, I hope Dale didn't mind robbing the cradle like that. So, but anyway, so big congratulations there. And then we also wanted to welcome our newest member to the Stonebridge team, Mike Greer. Mike joined us late last year. Mike's got a very diverse, very well-rounded background that encompasses, corporate and corporations and the dynamics that go on there, as well as individuals in the financial planning. So Mike's able to kind of bring this very interesting perspective where he marries both big corporations and how that then impacts into the individuals around the planning. Mike's got a really unique way of kind of blending that kind of complex, but then creating, educational or in this case, something we had talked about, financial literacy. So he's able to kind of take some complicated and complex things and really kind of bring it down. Mike, just for, something we think is extremely interesting, very proud of, he's currently serves as vice president for the Chattanooga chapter of the National Association for Black Accountants. And we are extremely glad and happy to have Mike with us. So if you haven't had a chance to meet Mike, hopefully you will soon. And so with that said, that's Stonebridge. And then again, we're fortunate also to have with us from Lord Abbett, Joe Dwyer and Brian Dobbis. And Joe has worked with Eric and I basically since I think we started Stonebridge. Lord Abbett is a leader in fixed income, as well as other asset classes in terms of money management. They've been a big part of our short-term bond portfolio for all our clients for quite a while, and most recently helping us manage our emerging market debt sleeve for our clients as well. And then there's some other little nifty little things we've got in the portfolios there too. But Joe, we've been very fortunate, very happy to work with Joe for a long time. And of course, Brian and Joe, kind of tag teaming today. And Brian's been with Lord Abbett. I think we were just having a discussion, 20 plus years. And where Joe's on the investment side, Brian's done, not to overstate this, but basically all things retirement planning. So, I think we've got a lot of neat things, great experience that we can talk about on the Secure Act here. So with that said, Joe, just want to turn it over to you, and we certainly appreciate your time.
Yeah, absolutely. Well, I'll be real quick and then hand it off the keys to Brian. So for those of you not familiar with Lord Abbett, we were founded in 1929 with the singular focus on the management of money. That's really all we do. Today, we manage about $238 billion in assets. And one thing that makes us unique is we're an independent, privately held partnership. We have close to 50 partners in the firm. And there's really, three key differentiatives, that make us unique at Lord Abbett that Brian has up on the screen for us is, number one, our independent perspective. We're not owned by a big insurance company. We don't have our own publicly traded stock. The only people we have to answer to is the shareholders in our fund long-term, and that fosters a long-term perspective, much like Stonebridge. Stonebridge is an independent RIA, with the singular focus, right? Two is we believe there's inefficiencies in the market, whether it's credit-sensitive fixed income, municipals, as well as equities. And three, we try to focus on intelligent product design. You have the Vanguards and Fidelities of the world with hundreds of funds. We don't have a handful of funds, but we try to have customized solutions. In fact, in Barron's rankings came out for performance over the last 5 years. And out of 50 plus money managers, we were ranked top 5 in the industry. So we have a bevy of very good things happening at Lord Abbett, and that's kind of our 30,000 foot view. But with that, I'll hand it off to our expert today, Brian Dobbis. He's one of our most popular speakers at Lord Abbett, and glad that we could secure him today for Stonebridge and your audience. So I'll hand it off to you, Brian.
Thank you, Joe. Thank you, everyone. Good afternoon, or I guess good morning. Happy New Year, if you're allowed to say that in March. Happy New Year. Hope everyone is doing well. Needless to say, it's been a crazy 1 year. As we were just saying offline, it was 1 year ago that I was with Joe and out on the road seeing you folks live. Although a lot has changed in the last year, there is a couple of things looking through the prism of retirement planning that has not changed, and that is called the Secure Act. The Secure Act, which is an acronym for setting every community up for retirement enhancement, was signed into law back in 2019, which I know probably feels about like 500 years ago for a lot of you, myself included. It was the largest retirement bill or piece of retirement legislation since 2006. There's roughly 30 separate provisions impacting 401k accounts, IRAs, even 529 accounts, education accounts. And ladies and gentlemen, a number of the effective dates, a lot of them are live now. A lot went live last year in 2020. And I think as Dave said, and he's correct, that was the focus at the beginning of 2020 before COVID hit and the CARES Act. The focus for the advisor community, myself, all the time was spent on all the provisions impacting retirement investors on these various provisions. So we thought it'd be beneficial to come back to a lot of these new provisions, open it up to making sure you're aware of how these provisions will affect you, your families, and your retirement accounts, and share the information with you. And one other thing before we begin, we want to hear from you. So if there's any questions, I believe you have the ability, and Dave, correct me if I'm wrong, to unmute yourself. You're more than welcome to ask me a question, or I believe Zoom has a chat function. You can type in a question. So, feel free to make this a dialogue. I want to hear from you. And that goes for any of the FAs on the call. If you have any comments or questions, you're more than welcome to fire them away at me as well.
And Brian, I think we've got enough in terms of folks on the call that either is okay, whatever you're comfortable with. You can take yourself off of mute and ask a question. And don't, I mean, anything's fair game. Between Joe, Eric, myself, Brian, we should be able to, you know, come up with some plausible anyway, explanation or answer to whatever question that you ask. So, and then also, if you go down to the bottom of your Zoom, you've got chat. You certainly can type in a question if you don't want to ask it, and I can read it. So whatever you're comfortable with.
Thank you, David.
Yeah.
So, folks, let's start with one of the more popular provisions in the Secure Act, and that was the repeal of traditional IRA contribution, the age cap. Prior to the Secure Act, in the year you reached age 70 and a half, you were no longer eligible to fund a traditional IRA. The government said, okay, you now turn 70 and a half, you can no longer fund your retirement account, regardless of whether you needed to continue, regardless if you were still working. The government said, no, you now need to start taking minimum distributions. However, starting with tax year 2020, last year, you can now fund a traditional IRA at any age, although you do need a job, meaning compensation, earned income. So for any of our listeners today, if you or a family member are above or older than 70 and a half or older, you can now fund a traditional IRA. And by the way, folks, it's tax season. You can still make a traditional IRA for last year, for 2020 through April 15th. So even though I've said 2020, don't think, oh yeah, Brian, that's great. Why are you telling me now? It's not too late to make an IRA, traditional or Roth, for last year through April 15th. Now, folks, I mentioned a couple of times it's a requirement to have a job, compensation to fund a traditional or Roth, with one exception. If your family, if there's one spouse that works and one doesn't, maybe they stay home with the kids or whatever, maybe they're going to school, whatever the situation may be, the non-working spouse can establish an IRA using the working spouse's income. That's called a spousal IRA. So if me and my wife, we're married and she stays home and I work, I can then fund an IRA on her behalf using my income. However, as you see on your screen there, you must file a joint tax return. If you are married, filing separately, the spousal IRA rules I just mentioned do not apply. So what else does the deductible, the repeal of the age 70 and a half mean? Well, you can now make a deductible IRA contribution. So you can reduce your taxable income. You can fund a retirement account and get a tax deduction. So even if you don't necessarily need the money, which I know is a really good problem, you can still get a tax deduction, reducing your taxable income. And finally, it expands the opportunity for a strategy called a backdoor Roth. And I'm going to get a little technical here, folks. And if this is something that you feel is like it could work with you and your families, I would write down the buzzword backdoor Roth and either ask me questions in the chat or reach out to your advisors. So if you're over 70 and a half and you're still working and you and your family still are bringing in a lot of money, which is a great problem, you're still a high income earner, there's a strategy called the backdoor Roth where you make an IRA contribution to a traditional IRA. You don't get a tax deduction, so it's just after tax money going into a retirement account. Then you turn around and you convert it to a Roth IRA, and there's no taxation. And I know it's a very high level overview of what the backdoor Roth is, but again, you weren't able to utilize this technique before the Secure Act because you couldn't fund a traditional IRA once you reach 70 and a half. Now you can. And finally, I know this is going to come up at the next family event. Traditional IRAs were the only retirement account for which contributions were not permitted due to age in the first place. So for some reason throughout the years, Congress imposed a 70 and a half age cap on traditional IRAs, but no other retirement account has that 70 and a half rule. Roth account, SEP IRA, simple 401k, you can fund at any age as long as you're otherwise eligible. This is a big one, folks. Required minimum distributions. And if you can bear with me, I'm going to try not to get into the weeds too much, but if you are approaching age 72 or you're 72 years or older, there's a lot of moving parts regarding minimum distributions. As I'm sure you're all aware, the CARES Act for 2020 waived RMDs. So last year, you didn't need to take the money. I mean, you can always take a distribution if you want, but the government wasn't mandating it. However, for 2021, required minimum distributions have returned. But, and I've been getting this question a lot, therefore I added it to the seminar. Your 2021 minimum distribution is calculated as if the 2020 waiver had not occurred, meaning there's no makeup. It's like 2020 never happened, which I think for a lot of us is probably a good thing, right? But strictly from the prism of required minimum distributions, you don't need to double up. It's like 2020 never happened. You start fresh. Now, getting back to the Secure Act, folks, the Secure Act increased the RMD age to age 72. This was supposed to happen last year, but again, RMDs were waived. Therefore, the takeaway here, ladies and gentlemen, if you are age 70 and a half this year or 71 this year, you do not need to take a minimum distribution. The government has said, nope, you don't have to. It doesn't start until you reach 72. But again, let me be clear. If you need the income, you are more than welcome to take the money. Furthermore, mirroring current law, if you do turn 72 in 2021, you can defer your first minimum distribution until April 1st of 2022. But if you do that, if you say to your financial advisor, you know what, I'm going to wait till next year, that's fine. But then what happens? You need to take two distributions next year, one for 2021 and another one for 2022. And that's where your advisors can help to determine, based on your financial situation and ultimately the tax liability, whether it makes more sense to do RMDs in separate year or maybe double up for that 1 year. IRA 401k owners who turned 70 and a half way back in 2019 are subject to the old pre-secure rules. Now, folks, let me change gears here. I've been talking predominantly about the IRA universe. 401k required minimum distribution rules differ. So let me explain what I mean by that. Let's start with the IRA side of the ledger. Let's make this really easy. In the year you turn 72, you have to start taking minimum distributions from all your IRAs except for Roth IRAs. Case closed. On the 401k side of the ledger, if you are still working for the employer that sponsors the retirement plan and you own 5% or less of the company, you do not need to take RMDs until you retire. So let me use an example. Since Mike and I are making eye contact, even though Mike doesn't realize that, I'm going to use him as an example. And Mike, I know you're not 72, so don't take this personally. If Mike is 75 and he's still working and he doesn't own 5% of the company, guess what, folks? Mike doesn't need to take a minimum distribution, 72, 73, 74. Therefore, RMD rules are, I guess you can even say, unfair. IRAs, you have to do it at 72. 401ks, you can, as long as you don't own at least 5% of the company, you can defer them. And again, that's where your advisors can help determine which accounts you should take RMDs from to generate income. If you're in that envious position where maybe you don't need the income, maybe you defer some of your accounts. Why would you want to defer them? To put off tax liability. Or let me give you another option. Maybe you want to start taking the income even though you don't need it. Does anyone know why? Let me repeat that. Maybe you want to start taking income today, even though you may not need it. Why? Because taxes are at a historic low, at least on the federal level. Remember, ladies and gentlemen, when you take a distribution from a retirement account, you will be taxed based on your marginal tax bracket in the year of the distribution. Taxes are relatively low. I'm going to stay apolitical here, but we do have a new administration who's been very apt about talking about increasing taxes. So if you say, hey, you know what, Mr. Financial Advisor, Mrs. Financial Advisor, I'm going to wait a few years to take those RMDs. Well, that's fine. That's your right. But the RMDs are going to get larger, most likely, and you may be taxed at a higher tax bracket. That is where your financial advisors, also known as your financial planners, will help you. And finally, just as a reminder, if you don't take your RMD or you take less than the amount that you should, there is a hefty 50% penalty tax on the amount that should have been but was not distributed. So folks, I thought I would do here for you is make one screen with all the different changes so you can kind of get a feel for all the different RMD changes from year to year. Now, I'm not done yet with the RMD universe. Guess what, folks? We have one more, we have one more change to go through. Next year, I'm already talking about 2022. And why am I bringing this in now? Because this is a good thing. I like to share good news. To determine your required minimum distribution, it's a really easy formula. And when I say easy, this is coming from someone who never did very well in high school math. So bear with me here. Your required minimum distribution is based off your prior year account value divided by a factor, how long the government thinks you're going to live. The factor has not been updated for roughly 20 years. And in the last 20 years, the average American's life expectancy has increased. So what the IRS did is the IRS went back and they retooled, they updated those life expectancies. Therefore, due to Americans living longer, what's going to happen is your RMDs starting next year will be somewhat smaller because they updated and increased life expectancies. And this will increase your lifetime RMD as well as your inherited RMD. And again, this applies next year. So next year, I know it feels like forever, but your minimum distributions of IRAs, 401ks, etc., will be somewhat smaller due to the life expectancy table changes. Dave, I'm going to just see if is there any questions from your team, from anyone in the audience, anything I can clarify?
Here. For me, Brian, just you know, we certainly want to make sure that, you know, we like that backdoor Roth. I think that's applicable, you know, because we have kind of a mix here of you know, the young and the old on the call. And we've also got folks that maybe with some of the things, and you may get into this later on. And we actually just like from the chat window, we, you know, definitely hit the backdoor Roth again, maybe that, but then also talk about how we can work with either on a 529 or even, I think you had a really good idea on a previous call that we were on with respect to kids, you know, getting them some income depending on, you know, your situation, and getting some Roths and things like that started for kids as well. So those are some areas that maybe to kind of hit as well. But definitely hit the backdoor IRA, and I don't see any other chats on at least what we've covered so far.
So here's what I'm going to do, Dave. Great commentary. Thank you. I'm going to go through the qualified birth or adoption. This is a new rule. Mm-hmm. And since it deals with children and or adoption, I'll then lead into some Roth IRAs for kids. And I think our audience will really like that. So let's talk about the Secure Act includes a new distribution option from your retirement account, your 401k, your IRA. You can now take a distribution from your retirement account for the birth of a child or a qualified adoption up to $5,000. There is no 10% penalty. As you may be aware, ladies and gentlemen, if you take a distribution from a retirement account before you reach age 59, there generally is a penalty in addition to federal and state taxes. With this new option, there is no penalty. So what the government is saying here is, all right, we understand when you have a child or you adopt a child, it's really expensive. We're going to allow you to tap your retirement account up to $5,000. Yes, the distribution will be subject to income tax, but there is no penalty and you can repay it. So if you look down towards the bottom of your screen, a parent who took a distribution is later able to repay such amount. So me and my wife, we have a child, we can each take $5,000 out of our respective retirement accounts for a total of $10,000. And then at a later date, we can say, hey, you know what? We now have the money to repay this. However, and this is key, ladies and gentlemen, couple of key takeaways here. Unfortunately, and you might be chuckling to yourself, when Congress wrote the law, they didn't tell us what the repayment deadline is. We don't know. Is it a year from now? Is it 10 years from now? We're still waiting for them to provide us some information. And I'm saying that a little, kind of tongue in cheek, but unfortunately, it is the truth. The second piece of the equation here is in the 401k universe, your employer plan is not required to offer this. So if you hear me talk about this and you're like, oh, wow, this is great, I didn't know. And you go to your human resources department and say, I heard there's this new distribution option. They may be, sorry, we don't offer it. And that is their right. That is the plan's decision whether or not to offer this as a provision. And again, this went into effect last year, January of 2020. And my final comment is, I got some questions on this, which I think is kind of funny, but I got it so frequently, I guess it's common. What about if I have twins? Well, guess what, folks? Each child would be considered a separate event. So you could take $10,000 out of your account, one for each child. And if you have triplets, $15,000, so on and so forth.
Hey, Brian, what is there a look back? Let's say, you've got a kid that's 1 or 2. What's the and maybe you covered that and I just missed it, and apologies if you did, but what's the time frame on that? With
1 year, David, distribution is permitted 1 year. So a couple of things, and David brings up a great question. You cannot utilize this provision until the event actually happens. Meaning, if my wife is pregnant, I can't take a distribution until she actually gives birth to the baby, and then up to 1 year later. And if it's an adoption situation, you actually have to have I hate to use contract when you're talking about children, but you actually have to have the paperwork signed off in order to use the distribution for a qualified adoption. All right, now, I want to change gears here. And David brought up a great point, and I'm going to take a moment or two to go into this. And that is establishing a Roth IRA for a minor, for a child, for a grandchild. Ladies and gentlemen, I mentioned in my opening slide that in order to be eligible to contribute to a Roth IRA or a traditional IRA, the account owner needs income. They need a job, some form of compensation from a job, not from dividends, not from interest, not from workman's comp. You actually have to have a job. That being said, what I have seen over my years of doing this and continues to be as popular as ever is establishing a Roth IRA for a minor. So in your families, ladies and gentlemen, if you have kids or grandkids that have some form of income, maybe they worked part-time at the local grocery shop or at a big box store, or they're a lifeguard or a babysitter or whatever, as long as they have reportable earned income, you or anybody can set up and fund a Roth IRA on their behalf. So if I have a child who made $2,000 last year in 2020 working at Whole Foods as a cashier, I can set up a Roth IRA and fund it for $2,000. Now, there's a couple of takeaways here, ladies and gentlemen. First and foremost, you heard me say last year, can you set up and fund a Roth IRA for a family member, a minor from 2020? Absolutely. Again, that's through April 15th. So you can do that for last year. And secondly, this is a key takeaway. The government could care less who funds the Roth account on behalf of the minor. I can write a check out and fund my daughter's a Roth IRA, meaning, and this is important, you're not trying to beg and plead with a 15-year-old or 14-year-old to take their hard-earned money to set up a retirement account. Because let's be honest, you ever going to win that argument? Highly unlikely. If you do, let me know, because you'd be the first. That's why it's so important. And what we've seen, folks, we've seen the grandparents funding Roth IRAs for the kids. We've seen even more recently, mom and dad matching Maybe the kid donates $100, the parents will put 50% in, anything to get them to start saving for retirement at a young age. Furthermore, you might be thinking, well, Brian, that's great, a Roth IRA for a 15-year-old, but that's like really long-term. Is there anything we can use the money for, maybe on a shorter time horizon? And the answer would be yes, college. You can always withdraw your Roth IRA contributions tax and penalty free. So if David has a client who's contributed $30,000 and the account rose to $40,000 due to growth, you can withdraw the $30,000 to pay for college, books, tuition, fees, no taxes, no penalties. So Roth IRAs for the kids are not only good for a long-term investment, retirement, you can also use them for a shorter time horizon, such as college, because you do get the tax and penalty-free treatment of distributions. David, any questions or anything you would like to add to that?
Nothing in terms of, again, a great, kind of a great opportunity, great segue. I think one of the things I thought was interesting, if we've got folks that own their own business, one of your, like, to give certain, kids, grandkids jobs in their small business, you came up with a great idea, which was, take some pictures of them, put them on your website. Now they're models.
Yes.
And, and again, if you're comfortable with that, if you're comfortable putting your children on your website, but that, and then now they got income, you can pay them for that. Then that can be, put into the Roth account for them.
Yeah, David, let me take a moment and expand on that, folks. And for any of our listeners today, if you or a family member own your own business, I don't care what the business is, as long as you're the owner, and you have minors, maybe you have a 2-year-old or a 3-year-old or a 4-year-old, and you're thinking, how do I get earned income? How do I get compensation for the 2-year-old? Well, as David said, a very creative idea is you snap a picture of the child, you post the child's image on the website, and now they're a model. They now do advertising and they get paid. Or if you don't, like David said, if you don't feel comfortable posting the picture of a minor on a website, we've had a lot of people who just include the picture in emails, or if you use old school advertising and you mail items to clients or prospects, anything to get them earned income. And then you got to have a 2, 3, 4-year-old funding a Roth IRA from the modeling income. And again, ladies and gentlemen, I've had a number of folks utilize this over the years, and it's a great, great creative way to get your kids or your grandkids funding retirement accounts at a very young age.
Yep. Hey, Brian, can we let's take a step back, go into one of the earlier comments where you talked about, because we do have a couple of kind of clarifications. Walk us through again the backdoor IRA, why you would do that as opposed to just putting money into a Roth directly. So maybe you can kind of cover some of the ins and outs. And then we got one other question after that around HSA accounts.
Okay, great. So, HSA is one of my favorite topics, so I'm glad we got that question. But the backdoor Roth. So, ladies and gentlemen, to be eligible to establish and contribute to a Roth IRA, there is an annual income test. The government says you, the taxpayer, can fund a Roth IRA as long as you meet 2 requirements. 1, you need compensation. And B, your income cannot be over a certain amount. So for 2021, the income test, if you're married, is roughly $200,000. And if you're single, I think it's about $125,000. I don't remember the numbers off the top of my head. But if your income is over those amounts, the government says, no, you can't fund the Roth IRA. You're out of luck. So there's a little technique. There's a strategy to avoid the income test. What you would do is you would instead establish a traditional IRA, which again, everybody is eligible regardless of age. All you need again is compensation. Income is total household income is irrelevant. So let's use myself. Let's say I make crazy amounts of money and I can't fund the Roth. My advisor, David, would say, Brian, send me a check for $6,000 because that's the maximum limit. I would then fund a traditional IRA of $6,000. And then David would turn around and convert the $6,000 into a Roth IRA. That transaction, that conversion would be non-taxable. Why? Because the $6,000 I contributed is all after-tax money to begin with. Ladies and gentlemen, this is just a loophole. It's a strategy. It's an extra step. At the end of the day, I am still have $6,000 in a Roth account, but my advisor helped me with this strategy to ensure that I got Roth dollars without any taxation to myself. Therefore, if you're ineligible to fund a Roth IRA directly due to those aforementioned limits, I would urge you to speak with David, Mike, Tom, and the rest of the team and see if a backdoor Roth is viable for you and your family. And once again, and I know I probably sound like a broken record, but I don't want anyone to miss out on this, you can still do this for 2020. So if I didn't make my IRA contribution for last year, can I send David $12,000, $6,000 for 2020, and another $6,000 for 2021? Yes, I can.
And again, for those over 50, I think you add $1,000 to that.
Correct. Yes.
Brian? So that
is absolutely correct.
And then, another great question here, just again, spousal IRAs. So a non-working spouse, what are the kind of options that they have for something like this? Could they also do the Roth?
Absolutely. So lady, great question. The non-working spouse has all the options that a working spouse has. There's no difference. The one caveat is if you're going to be utilizing the non-working spouse called the spousal IRA, you and your spouse must file a joint tax return. If you're married filing separately, the spousal IRA rules do not apply.
Okay. All right. Well, now let's. Okay. What about some respects to passive income? So like rental income. And again, one thing I do need to say, Stonebridge Asset Management, we're not CPAs. We're always defer to your accountant. We'd love to work with your accountant as we keep getting into some of the more nuanced of the tax advice here. But we're definitely talking about some things that we certainly can help you with, and we always want to involve your CPA just as best practices when we move forward with these strategies. But another great question with respect to rental income, is that considered earned, or is passive income that comes off rental income?
Unfortunately, no. Passive income, rental income, royalties, workman's comp, Social Security, none of that is considered compensation for the purposes of funding an IRA.
So you need to receive what, a 1099 or a W-2?
Schedule C, 1099, W-2, yes.
K1, okay.
Yes,
right.
Yeah, anything that's considered compensation, correct.
Okay. All right. And with that said, you want to tackle the HSAs.
All right, ladies and gentlemen, health savings accounts. This is one of my favorite topics. I think if COVID has taught us anything, it's how important and crucial it is to have a pool of funds available for unexpected medical expenses. And that is exactly what a health savings account is. It is a pool of money, it is a pool of tax-advantaged funds to use for current or future medical expenses. A health savings account is a triple tax-advantaged account. Assuming you're eligible, and I'll go through the eligibility in a moment, you receive a tax deduction on the federal level, the state level, unless you live in New Jersey, like myself, because they're the only state who doesn't provide you a state tax deduction, and your earnings are distributed tax-free. So a health savings account, in a way, is almost better than a Roth IRA. Why? Because a Roth IRA, as great as they are, and I love them, don't offer you a tax deduction. You make a Roth IRA contribution with after-tax money. A health savings account you make with pre-tax money, and your earnings and your initial contribution are distributed tax-free so long as you use the money for medical expenses. Furthermore, I'm sure a lot of the callers today, a lot of our listeners are familiar with flexible spending accounts, FSAs. Do not get them confused. Flexible spending accounts, unlike HSAs, have one huge drawback, which is called use it or lose it. So meaning you have to use the money within the same year generally. Ladies and gentlemen, health savings accounts are awesome. You can reimburse yourself anytime for the rest of your life. So for example, if me and my wife and our dependent children, say over the years, we've accumulated $30,000 in medical expenses, and we paid that $30,000 of medical expenses out of pocket. We saved all our receipts. Guess what? I can call my financial advisor and say, send me a check for $30,000 from my HSA, and the taxation to me will be zero. HSAs do not have a use it or lose it feature. You save up all your receipts. You work with your advisor to set up a portfolio, because you can use mutual funds and whatnot to invest the money. And then anytime throughout your lives, you can then reimburse yourself. Or I should say, or you can use an HSA tax and penalty free to pay for Medicare and long-term care premiums as well. But there is a but here. In order to be eligible to fund and establish a health savings account, you need to be enrolled in your employer's high deductible health plan, otherwise known as an HDHP. Ladies and gentlemen, if your employer offers a high deductible health plan, or if you're already enrolled in it, I would urge you to speak with David and team regarding the benefits of a health savings account for you, your family, and your dependents.
Well, thanks there for sure. That's some good little nuggets, knowledge nuggets, Brian. We appreciate it very much.
Yeah, I'm a big advocate of health savings accounts.
Well, and we're starting to see, like you mentioned, the opportunity to, as you fund these, as you look at the the benefits that your employer's offering you, and then how you utilize those, and to even kind of be forward thinking. And you mentioned that with payment of premiums. So when you do wind up on Medicare, you're able, because there are premiums depending on Part A, B, all the different things there. So you're able to utilize that, as well as your long-term care. Again, interesting and a little more creative. That money can sit there and can grow. As you mentioned, you can build some folios, but it's only, and this is interesting, Brian, I feel like this is only being really pushed in the last, say, year or so. Have I been out of touch? Does that seem that it's become more prevalent? What's your experience there?
More prevalent, David, for a couple of reasons. One, more employers are offering high deductible health plans, so more people are eligible. And secondly, as we all know, we've either read it or experienced it, healthcare costs are crazy. They're increasing faster than inflation. So people are concerned, and they're looking for different ways, tax advantage ways, to have a pool of money for either current and or future medical expenses. Because the rule of thumb generally is, as you age, your medical expenses go up. Therefore, what we are seeing is specifically the millennials and the Gen Z, they are attracted to these health savings accounts. Why? 'Cause if you're healthy, it's a no-brainer. Your premiums for health insurance are subsidized, and you can use the money to fund future medical expenses.
And a great question that just came in. What's the cap on, or is there a cap on the HSA accounts?
Yeah, there is. So it is, I believe, $3,550 if you were single, and you just double that, $7,100 for family coverage. So single coverage, $3,550, $7,100 if you're for a family. And there is a catch-up, folks, of $1,000, but it's age 55, not age 50. And finally, if you were enrolled in a high deductible health plan for last year, you can fund an HSA. Guess through what date, folks? It's who's been following. April 15th.
Well, and again, Brian, that limit on the HSA, does it matter? Is it per family? I think that's what you said. So if I've got one child, five children,
Yes.
I'm only going to be, I can't, like with the Roth or whatever, or like with, I think the deduction with the 401k on childbirth, it's not a per child, it's just either individual or family. So the 75.
David, you might have opened up a can of worms here, but
Okay.
I'm going to take a moment and go into a little detail. It looks like we have a couple of minutes, and if anyone's jotting down notes, I would urge you to jot these down, or if you have any clarifications, type in the question. Just bear with me here, folks. This is a really cool idea, and I owe David the credit, because if he didn't bring this up, I probably wouldn't have thought about it. Obamacare, the Affordable Care Act, increased the age of which you can have an adult child on your health care to 26. So you can potentially have a child on, you're paying for your child's health care up to age 25, even if they're independent of you. So what does that have to do with HSAs? Well, guess what, folks? If I have family coverage, and let's say it's me, my wife, and my twin daughters, they're both 23 years old. They're both working full time, but they bypass their employer's health insurance, because I'm a very generous dad. I'm paying for their health insurance. Guess what my family coverage can be? Well, let's watch how this works. I said earlier, 7,100. That 7,100 is only for me and my spouse. So me and my spouse could put $7,100 in between her HSA and my HSA. We can split it. I can set one up for me. I can set one up for whatever, as long as it doesn't exceed. Well, guess what, folks? Since my daughters have coverage through a high deductible health plan and they're independent, they get their own HSA limit. And furthermore, anybody can fund an HSA on their behalf. So if I'm a really generous dad, can I give my daughter fund an HSA for them and give them a tax deduction? Yes, I can. Which then takes the $7,100 limit and triples it.
There we go. That's pretty strong to say that. And again, we'll just say using what's available to us. I think that's the key to all this. I do have a couple of questions that came in, Brian. Does the HSA, again, it's basically to be able to have an HSA. It's not about your earned income anymore.
Correct.
It's about what type of insurance benefit does your employer, or if you're a business owner, what are you providing, And so as long as you have, I think what you called it, the high deductible health plan, as long as you have that type of plan, that's where you have the HSA option, correct?
That is correct, David. I couldn't have said it any better. Your income is irrelevant here. It's simply whether or not you are enrolled in a high deductible health plan. So unlike a Roth account, there's no income test. Here, the test is simple. Are you enrolled in your employer's high deductible health plan? If yes, then you may be able to open up an HSA. If no, then you need to check with your employer and see if they offer a high deductible health plan. And if they don't, unfortunately, you can't fund one at that point.
Can I ask, what is there some technical definition of an independent adult child?
I'm going to give you a very, very, very high level 40,000 view. If they file their own tax return, they're independent, but by no means is that an across the board. That's where the accountant will come in and make that determination. But that's a rule of thumb I've seen.
Okay. So they need to talk to their tax accountant.
Yeah, pretty much.
Well, and again, we did get another in the chat box, just about repeating the funding for the adult children. So does that kind of, I think when you did with the Obamacare, is that in the same vein here, or is that where there's a little bit more nuance? And then also one of our really informed listeners, I think they just let us know that it's up to $7,200 for 2021 on the HSA contribution. So thank you to our some of our participants. They're on their game, as you can tell by the level of the questions that we're getting, Brian, which is great.
That's great. Well, that's good. That means they're double checking me, and I'm right. So
yeah.
So yeah, 30. You can always remember the HSA contributions. The family coverage is always doubled. So is always double what the single coverage is.
Okay. And again, any other nuance with funding for adult children, Brian?
No, I would suggest if you do have, my suggestion is if you are covered by a high deductible health plan and your adult independent children are on your plan, work with your accountants to see if you can utilize this. And again, you are giving your kids a tax deduction. And now I know if you're in Tennessee, I know there is no state tax, which I'm very jealous about, but whatnot. You're still at least getting the federal income tax deduction, and there's a pool of money growing for future medical expenses, or even to cover deductibles and co-pays and co-insurance and everything, prescription medicine, so on and so forth.
Hey, Brian, a quick clarification. I think you said it, but you've got a married couple and they've got this child that's under 26 or under. You said it's a rule of thumb that he or she's filing their own tax return, but the tax deduction is the parents, correct?
Well, if the parents fund an HSA for the parents will get the tax deduction. If the parents fund the HSA for the kids would get the tax deduction.
Okay. So the parents are funding it for them. The child is still on their health care plan, so the child gets the benefit of the deduction.
Oh yeah, I mean the child is getting a win-win-win. They're getting free healthcare paid for by mom and dad. They're getting a pool of money for future healthcare, and they're getting a tax deduction.
Okay, just wanted to make sure.
Yeah, no, you got it, Tom.
Yeah. All right, we're coming in. We've got about 8 minutes or so left. Right. So out of respect of everybody's time, I mean, we can just continue to talk. I've just got, I apologize. We had one more coming in. All right. I'll read this one, but if all income, not earned income, but the individual pays for the high deductible insurance plan, what if all the income's not earned income? I think again, around the construct of how is it paid? If you're as the parent of the adult children or the children in general, does it matter how you're paying for it? Is it just going to come out of your earnings from your business? And again, I'm thinking like a business owner here. So if a business owner, just from his distributions, from his guaranteed payments or whatever, it doesn't really matter how he's funding. The IRS doesn't look at that, or they just, however the money gets in there, it gets in there. Is that correct? Or is there a nuance to that?
I would suggest, if anyone thinks they're eligible or they're to do two things. One, check with their accountant to see if they can do this. And B, if they can, then the follow-up question to the accountant is, how do I do this? What pool of money? How do we report this to make sure it's done legally, of course.
Yeah, exactly.
And of course, to make sure they get the biggest
full
bang
benefit
for their buck for the tax deduction.
Right. And again, Brian just said it. We always consult with your accountant, for the final say on all things tax. And then, anything, and again, just because we're running out of time and I wanted to bring it up, but any comments on 529s or anything like that?
Yeah, let me see if I have it here.
Okay. And that can kind of be our final little, oh, sorry, we didn't get half your slides.
I like this. It's great. 529 accounts. Two big provisions that were included in the Secure Act. Number one, apprenticeship programs. Congress expanded qualified distributions, meaning you can now distribute 529 funds to cover apprenticeship programs. So in other words, qualified distributions, which are tax and penalty free, are not just for higher education. So you can now pay for an electrician, a programmer, a coder, to pay for fees, books, supplies, and required equipment. But the program must be registered with the Department of Labor. So this isn't for any apprenticeship program. It has to be registered. The DOL does have a web page with their registered programs. Secondly, and this is the big one, ladies and gentlemen, you can now use 529s to pay off student loans up to $10,000 per beneficiary. That's good. That's very good news. The not so good news is that $10,000 is static. It's not indexed for inflation. So if you have money left over for 529 accounts, you can now repurpose it to pay off a student loan up to $10,000 per beneficiary.
Okay. Again, I know there's different states and things like that. What's the purpose, Brian? Just kind of out of left field here. What's the purpose, or why are they set up? Because it's sometimes confusing for our clients, and where, you know, this state offers it, that state offers it. It's a national plan. Is there any difference? You know, if you live in a state, do you need to have the 529 plan from the state, or can it, you know, does it matter?
Yeah, good question. So generally speaking, each state partners with an investment house, a mutual fund company and whatnot to offer a state plan. And why they do that is a lot of states offer tax credits or tax deductions to their residents if you use that state's plan.
Okay.
And they'll say, yeah, you can go to another state, you know, Mr. Resident, but you're not going to get a tax deduction. And maybe some other benefits available. So they try to draw you in to use the own state's plan with some sweeteners. Of course, not every state does that, and not every state allows non-residents to use their 529 plan.
Okay. Good to know. And again, you can probably go to that state and look at their website to see, you know, if they provide a tax credit for residents or not. I would assume it would be listed on there. Yeah. Okay. Any other, again, I know we're kind of running out of it. Are there any other questions? Again, kind of a free for all. We'll make the last few minutes, you know, whatever you want to talk about.
I have a quick question.
Yeah, Mike?
Brian, will you speak to go back to the HSA and speak to the portability of that? If they establish one while they're working with an employer, then when they separate, what does that look like, and can they continue to add to the HSA afterwards?
Tremendous question. Unlike an FSA, you own the HSA, Mike. It is yours, like an IRA. So let's just use myself. I work for Lord Abbett. I have an HSA with Lord Abbett. I leave Lord Abbett. That HSA is mine. I can move it wherever I want. So if I want to now work with you, Mike, and transfer my HSA to you, I can do that. And it would be done just like an IRA. I would move the money directly from the Lord Abbett plan to you, and then I would use it going forward based on all the rules. Now, whether or not I can contribute to it would determine on my new employer and whether or not they offer a high deductible health plan. So you can transfer HSAs generally at any time, either while you're working for the employer or after you separate from service. So Mike, you may not have asked this question, but what about if I don't like the HSA that Lord Abbett offers and you come to me and say, hey, work with me, my HSA is great. Could I transfer it? Sure. But my employer may not send new dollars to the new HSA because they're like, no, I don't want to do that, because then they have hundreds of people asking the dollars to be sent different places.
Thank you.
Yeah, great question, Mike. Thanks. Okay, well, with that, I mean, if there are no other, because we're right up on it, if there's no other questions or comments, I just want to certainly thank everybody for their time. You know, I hope you found it as in fun and informative as I did. A lot of stuff that was, you know, covered here. I'll ask this question. I know you showed some slide decks and things. Are these things that we can, you know, if we get asked, Brian, are these things that we can maybe forward on, or is this, you know, top secret from Lord Abbett?
I don't see any reason not. They're all been approved for client consumption. So yeah. I think it should be fine. And I just, in lieu with your question, we do have a web page that has a lot of the content on it as well. So, you know, if anyone would like to utilize that, and, you know, I'm happy to help Dave, Mike, Tom, Eric. I'm happy to support you guys any way I can as well.
Well, we certainly appreciate, again, and Joe, I know that, you know, we had to kind of shut you up. You were talking way too much.
It's okay. I'm all right.
But anyway, yeah, I was going to try to play a game with you, Joe, like guess what part of East Tennessee with your accent where you're from. So, so anyway, didn't get a chance.
Johnson City.
Exactly. Oh man. Listen, everyone on the call, thank you so much for your time. We really appreciate it. Be on the lookout for additional events that we do. If you need to get more information on any things that we talked about, please don't hesitate to reach out to everybody. Whoever your contact is at Stonebridge, and we certainly appreciate your time. Hopefully you found it as fun as we did. Brian, Joe, we really appreciate it. See you guys. Take care. Bye-bye.
Bye.